Hello everyone, welcome back to the channel. Today's video is going to be my 2023 introductory guide to dividend stocks for beginners. This is the penultimate installment in my series of 2023 guides that I'm releasing to provide you with clear, concise, and reliable information that will set you up for investing success in the decades to come. In this guide, we're going to talk about what dividend stocks are, why dividend stocks can be a good addition to your portfolio, how you find dividend stocks, dividend stock pitfalls to avoid, and some disadvantages of dividend stocks that are important to be aware of. So let's start off with the obvious question. What are dividend stocks? The term dividend stock is used to describe a company that is known for paying a dividend to its shareholders. As we covered in previous episodes, a dividend is a payment made by a company to its shareholders as a reward for continuing to own shares in the company. So when a company gets a reputation for being a consistent dividend payer, it then becomes a dividend stock because you're likely going to receive a dividend from owning that stock. Not all companies choose to pay their shareholders a dividend, hence why the term dividend stock even exists in the first place. Why would we need that term if every company paid a dividend? Companies like Tesla don't pay dividends to their shareholders. Instead, they use their cash to try and grow as much as possible, and if they're successful in doing so, shareholders will hopefully be rewarded through a higher share price. Other companies like Coca-Cola have paid a dividend to shareholders every year for the last 60 years. So clearly, if you're going to be investing in dividend paying stocks, you're going to need to know what companies pay a dividend and what companies don't. But more on that later. But why should you invest in dividend stocks? Are they 100% necessary in order for you to be a successful investor with a 7-figure portfolio? No, they're not. As we've talked about many times on the channel, if all you did was invest consistently into low-cost, passively managed ETFs for 20 to 30 years, you'd be a very successful investor. It requires virtually no time commitment on your part and involves little to no research or active participation. Essentially, it's the average person's best friend when it comes to investing. Dividend stock investing is not that. It requires time commitment in the form of initial upfront research, and it also requires some degree of active participation to evaluate the ongoing performance of the dividend paying company that you're investing in. So why bother? Well, the reason why dividend stocks can be worthwhile is because they provide what's known as a regular realized return on investment. Ask yourself, at what point do you make money from investing? Some of you might think that you make money when the company share price increases above what you paid to buy those shares in the first place. And that is correct on paper. In reality, you don't actually make money from investing until you sell your investments. And until you do so, all of your profits are what's known as unrealized profits. When you sell your investments and your profits are sitting in your brokerage or bank account for you to use in whatever way you see fit, that's when they become realized profits. The issue with unrealized profits is that they're subject to change. They're at the whim of the market. One day, your investments could be performing very well and you could have lots of unrealized profits. Next thing you know, a global pandemic breaks out, or inflation starts running rampant, or a recession happens. All of a sudden, those unrealized profits might turn into unrealized losses, depending on your investments. So it's not real money until you sell. Dividends, on the other hand, are real money. They are cash payments made to you by a company, and the value of those cash payments will depend on how many shares you own and how much of a dividend the company is paying for every share owned. With dividend stocks, you don't just make money when you sell the stock for a profit. You also make money from owning the stock. Considering most dividend paying companies pay dividends on a quarterly basis, i.e. once every 3 months, the payments themselves can be described as a regular realized return on investment. You're generating a regular, real profit from your investment without needing to sell the investment. You can use the money that you receive in any way that you see fit, but most dividend stock investors would take the money and reinvest it in more dividend paying stocks, which in turn would earn them even more dividends. Doing this consistently for decades unlocks the power of what's known as compound interest, and over time, the dividends that you earn from your investments become very large. Dividend stocks can also be a great investment in times when inflation is rising. We'll talk about this in more detail later in the video, but good dividend paying companies tend to increase the size of their dividends consistently, which is good for protecting your investment returns from the effects of inflation. Inflation reduces the purchasing power of our cash. Dividends are a cash payment, so therefore, if those dividends aren't increasing at the same rate as inflation, then their real value will decrease. Regardless, because we're receiving a dividend in the first place, we have a form of regular realized return plus whatever unrealized returns we have as a result of share price increases. The combination of these two returns will hopefully produce a return that at least keeps up with the rate of inflation. The last thing I'll say about dividend stocks before we talk about how to find them is that they somewhat protect you against bad corporate decision making. If a company chooses to pay you a dividend, you at least know that you're receiving a regular realized profit from your investment. Now, by paying that dividend, the company has less money to use for other purposes like growth and expansion. That's not a big deal for cash cows like Coca-Cola, but it is for new and innovative companies like Tesla, hence why they don't pay a dividend. So if you're a Tesla investor, you likely don't mind not receiving a dividend because you're hoping that what Tesla's management team does with Tesla's cash today will result in higher share prices in the future. But here's the problem. Not all management teams make the right decisions. Yes, they can say that they're going to do X, Y, Z to increase the share price, but there's no guarantee that that will actually happen. They could very easily waste a lot of money on bad decisions, money that could have been yours in the form of a dividend. With all of that being said, how do you actually find dividend stocks to invest in? There are thousands of companies that pay a dividend, and while you could go looking for them manually through Google search or otherwise, you're better off just sticking to the companies who are renowned for being the highest quality dividend payers. Conveniently, when it comes to American dividend paying companies, there are two lists that contain the best of the best. Those lists are known as the Dividend Kings list and the Dividend Aristocrats list. What is a dividend king and a dividend aristocrat? A dividend king is defined as being an S&P 500 member company who has not only paid but also increased their dividend every year for at least 50 consecutive years. Now, if you're new to the world of investing, it might be hard to conceptualize just how impressive that status is. But let me tell you, increasing your dividend every year for half a century is nothing short of miraculous. We're talking about companies who have increased their dividend every year despite stock market collapses, global recessions, pandemics, you name it. These are companies who are not only wholly committed to their dividend program, but they also have the business, the cash flow, and the profitability to support that commitment. In my eyes, if you're going to add dividend paying stocks to your portfolio, I don't see why you would go for any company other than the companies included on this list. They are everything you could possibly want in a dividend paying stock. It might come as no surprise that there are less than 50 companies that meet the criteria of a dividend king. Companies such as P&G, 3M, Johnson & Johnson, and Coca-Cola. All of these companies have increased their dividend every year for at least 50 years. So when you buy those stocks, you know that it's very likely that your dividend will not only be paid, but it will also be increased. Because remember, a company is under no obligation to pay a dividend, with the exception of real estate investment trusts, better known as REITs. So because dividends aren't mandatory, there's no guarantee that the company will continue to pay one. That's why the dividend kings are great, because they provide peace of mind. Dividend aristocrats are similar to dividend kings, with the only difference being that these are companies who have increased their dividend every year for at least 25 consecutive years. So not as impressive as the kings, but still no small feat by any means. So if you are someone who is interested in adding a few dividend stocks to your portfolio, again, I don't see why you would start your research anywhere else but the list of kings and aristocrats. They are the best of the best. When it comes to the mistakes that beginner investors make when trying to pick dividend stocks to invest in, there's one big one: the yield trap. One of the metrics that dividend investors use to compare dividend paying stocks to one another is dividend yield. If you think about it logically, when you buy one share in a dividend paying company, that one share is entitling you to a certain level of dividend, which of course is dependent on the company in question. By level of dividend, I mean how much of a dividend you will receive for every share in the company that you own. So therefore, we can express as a percentage the return that one share in a company will provide us from dividends alone, and we can compare these returns from one company to another. For example, let's say one share in a company is currently trading for $100. Let's also say that the company pays its shareholders a dividend of $1 per share every 3 months, which adds up to $4 in dividends over the course of a year. The dividend yield is calculated as the yearly dividend paid by a company divided by the company's share price at the time the stock is purchased. So in this case, the company's dividend yield is 4%, i.e. a $4 dividend divided by a $100 share price and multiplied by 100 to convert into a percentage. We can then compare this dividend yield to yields offered by other dividend paying stocks to see which stock offers better bang for your buck. On the face of it, it's logical to think that it's better to own dividend stocks which have the highest dividend yield. Why would you invest in a dividend stock that offers a 2% yield when you could invest in a dividend stock that offers an 8% yield? That's what's known as the yield trap. The assumption that having a higher dividend yield automatically makes one dividend stock better than another. This isn't the case. If you find a dividend stock offering a 10% yield, and there are many, what you need to realize is that you're not some genius who has stumbled across an untapped gold mine that no one is taking advantage of. The dividend yield is 10% because the stock price is low enough to make the dividend yield 10%. So you have to ask yourself, why is the stock price low enough to create a 10% yield? Well, if you remember from the first episode in this series, we said that the stock price of any company is influenced by A, the value of the company's assets relative to its liabilities, and B, the market's expectations for the future earnings of the company. So if the market's expectations for what the company will earn in the future are low, that will translate into a lower share price and a higher dividend yield today. Ask yourself, how does a company pay for its dividend? It pays for it using the cash flow that it generates from its business. So if the market expects that cash flow to be not so great in the future, what's the likelihood of the company being able to maintain its current level of dividend? Yes, the yield is high today, but that doesn't necessarily mean you're in for a high dividend forever. Bottom line, factors like dividend history and the strength of the company's business are much more important than dividend yield. Investing in dividend stocks on the basis of yield alone is a dangerous game. So now that we've discussed what dividend stocks are, why they can be a good investment, how you find dividend stocks, and the yield trap, I now want to talk about the biggest disadvantage of dividend stocks, which in my opinion is taxation. It's very likely that you're going to have to pay tax on the dividends that you receive, and depending on where in the world you live, the amount of tax that you pay can be quite large. For example, in Ireland, the highest rate taxpayers would lose 52% of their dividend to tax. Yes, you can make the argument that if you're paying tax, you're making money, but the issue is that the company you're investing in is also paying tax. The company earns money from its business and it pays tax on its profits. Remember, you are an owner of that company, so technically those profits are your profits, and those profits have already been taxed once. When the company then pays you your dividend from its after-tax profits, it's then taxed again. First, the company is typically obliged to withhold a percentage of the dividend paid to you. This is known as dividend withholding tax. Whatever you receive after that is then taxed in accordance with your country's taxation rules. It's worthwhile noting that you usually receive a tax credit for the withholding tax that you suffered on your dividend, but you get no tax credit for the tax suffered by the company on its business profits. So dividend investing as a practice is quite inefficient from a tax perspective, especially when compared compared to companies who don't pay a dividend and still achieve the same total return, or an even better total return. But of course, it's impossible to know what companies will and won't provide that. Many companies will forego the opportunity to pay a dividend in favor of a share buyback program, whereby they use their cash to repurchase shares in their company on the open market. This has the effect of reducing the number of shares trading, which effectively increases the share price for shareholders who currently hold shares. Therefore, you're receiving rewards in the form of unrealized profits rather than income in your hands, which of course would be taxed. It's typically advisable to invest in dividend stocks using a retirement account if possible. We'll cover retirement accounts more in the next episode of this series, but these accounts are usually exempt from tax in most countries, which can make dividend stock investing very efficient provided you use these accounts to do so. So that's everything you really need to know about dividend stocks as a beginner. In the next and final episode of this series, we're going to talk about pensions. We'll talk about what pensions are, why pension investing is important, how you invest in a pension, and much more. Don't miss it. So I hope you found this guide useful. If you did, you can show your support by leaving a like on the video and subscribing to the channel if you haven't already. If you have any questions on anything that we covered in this guide, please do not hesitate to leave a comment down below and I will answer your question to the best of my ability. Thank you very much for watching and I'll see you in the next one. Cheers.